Hey, what's going on? It's another video, this time number 3 of Unit 4, this time focusing on selling non-current assets. So previous video we did depreciation. If you haven't watched that, probably watch that first because we're just going to jump straight in. Just a quick recap though, we have what is in our balance day adjustments, which can be inventory gain and loss, already done that. Inventory write down, already done that. Prepaid and accrued expenses, did that video 1 for Unit 4. Depreciation was the previous video. Non-current asset selling, which is now. And bad debt and allowance for doubtful debt, which will be the next video. And unearned revenue, prepaid sales, all that jazz will be the last video for this area of study. We do have area of study 2 videos. So previously we talked about specifically how to do depreciation and how to buy an asset. And we just talked about here's what happens when you buy a new asset and accounting for all that little bits of information. Just a quick recap on top of depreciation. It goes straight line depreciation, formula on the screen. Reducing balance method is also on the screen now. We then go general journal, and the depreciation, always an expense, is a debit, while accumulated depreciation is a negative asset on the credit side. That's important for later. Now, let's jump straight into it. Now, as we know, you can't keep an asset forever. Eventually, if it's a car, it's going to break down. If it's a piece of equipment, it's going to become obsolete. That's how the world works. So we need to be able to dispose of an asset at a certain point. Now, businesses will have an idea what they want to sell it for, and that was called our residual value. But as we know, various factors, i.e. condition, the market, scarcity, can affect that residual value amount. As such, we need to be able to account for this and determine have we actually made a gain or a loss when we dispose of an asset. So, how we dispose of an asset, there are 4 steps. Now, there are technically 5, but I'm going to talk about that 5th one at the end. I probably want to focus on the 4, and then the 5th will be at the end. So, the first step will be we dispose of the non-current asset, we transfer the book value or cost price. So we transfer that cost price or historical cost. We then deduct the accumulated depreciation, and then we deduct the selling price or trade-in value. And then lastly, we deduct the profit, or we calculate the profit loss for the disposal of that asset. And then the step 5 is we create the new vehicle, which ties into trade-in value. So if we trade in, you need to do step 5. I'll talk about that at the end. So let's have an example. Let's just jump straight into the example. As at the 30th of June, the business had the following accounts from the post-adjusted trial balance. You can see vehicle, $25,000, and then vehicle accumulated depreciation on the credit side, $12,500. So that means it's about halfway through its useful life in terms of value. So they decided, and this is the post-adjusted trial balance, they have then decided to sell their vehicle for $11,000 plus GST. So, the first step, if we go back to our steps, we transfer the cost price or the historical cost. And it's disposal of vehicles debit $25,000 and the vehicle credit $25,000. So what happens is a twofold effect. It means our vehicle account is 0. Because at the end of this, we're not going to have the vehicle. It's going to be 0. No matter what, 0. The disposal of vehicle account is our mechanism to create or calculate profit or loss on disposal of an asset. So, if we have a look at the general ledger, pay particular attention to the vehicle account and the disposal of vehicle account. You can see here disposal of vehicle created, meanwhile the vehicle account balances 0. We then transfer the accumulated depreciation, and the accumulated depreciation starting balance was $12,500 on the debit side. So all we need to do is go disposal of vehicle, $12,500 on the credit. Meanwhile, accumulated depreciation of vehicle, $12,500 on the debit. We have a look now at our general ledgers. We can see disposal of vehicle. We have now added the accumulated depreciation. We can see $12,500 on that credit. Meanwhile, on the accumulated depreciation of vehicle, that negative asset, it is now 0 because we have cancelled out that $12,500. Then number 3, we transfer the selling price. Now, this is where there's been a new change, so pay attention. GST now needs to be factored in when we sell an asset for cash. Only when for cash. So please remember that. So if they sell it for cash from a dealer, for example, or to another person, account for GST. You need to account for GST. That was a recent addition once the study design started. That is something I think in the 2023 year they will probably test. You need to be on top of that. So you can see here, bank a debit $12,100. That $12,100 consists of disposal of vehicle, which is $11,000, and the GST clearing of $1,100 because 10% of $11,000. And then if we have a look, we can see our accounts here. I'm not going to put bank. I'm not going to put GST. We've seen those enough. But if we have a look at disposal of vehicle account here, we can see the debit side, $25,000. The credit side, what we got was $23,500. So in doing that, we now know, or we're now up to step 4, calculating profit or loss. And quite simply, if our debit side, the rule here is if the debit side is higher than the credit side, we have made a loss. If the credit side is higher than the debit side, we have made a gain. Very similar to the P&L summary. So remember, debit higher than credit, loss, credit higher than debit, profit. And in this case, we see debit is higher, ergo it's a loss, and we put that into the general journal as loss on disposal of vehicle, debit $1,500, and disposal of vehicle, credit $1,500. This is to make sure our disposal of vehicle account balances to 0, so both debits and credits are equal, and that is evident here where both sides total $25,000, and you can see the loss of disposal of vehicle, the debit $1,500 with the cross-reference of disposal of vehicle, and this will get closed into the P&L summary. Now, if we have a look, we can see the cash flow statement. This will be an inflow of $11,000. The GST would go in the operating as per normal. So this time cash is affected, and then for the income statement, the loss would go in other expenses. And you can see here, less other expenses, loss on disposal of vehicle, $1,500. What if it was a gain though? Well, if it was a gain, all it would go into is add other revenue, and you can see here discount revenue. That's the section it will go. So if you ever get a gain on the disposal of any non-current asset, other revenue is where it belongs. So those are the little aspects we just need to be aware about there. And then lastly, I just want to talk about the new vehicle and the trade-in. So instead of selling the vehicle, we trade it in for the same amount and we buy a new vehicle worth $25,000 plus GST, and we use cash to pay the balance. So disposal of vehicle stays the same. So if we compare the general journal from this new example of buying a new asset to the original, we can see here it's still a credit of $11,000. That stays as is. We need to create a new vehicle of $25,000. So that's a debit. And then GST clearing will be 10% of that. We pay that. Obviously, it's a GST outflow. So that's going to be a debit of $2,500. And then the bank is used to make this transaction balance. So that's where $16,500 as a debit belongs. Oh, sorry, $16,500 as a credit. There we go. So that is how we treat that. So that's the only change that occurs if you buy a new asset. You would trade in. So at the point where we dispose, at the point of trade-in, number 3, that's when we buy that new asset. So this is done at step 3, and then you carry on with profit and loss. So just be aware of those little aspects. So that's where creating new asset falls in, that hidden step 5 I talked about earlier. But we do combine that with 3. So some reminders. Please remember the 5 steps. Dispose of the non-current asset. So that means that cost price transfer. The deduct accumulated depreciation. Deduct selling price or trading value, whatever you sell or trade it in for. Profit and loss on disposal of asset is what we calculate next. And then if we're creating a new vehicle, we need to make sure we do that. And that ties into step 3. So it's that hidden step 5, but technically step 3. Other things I want you to remember, GST clearing must be added in. Please remember to add GST in. It will make your life so much easier. It's now a requirement. You need to be aware of that impact, but only on cash transactions. Again, this example was a post-adjusted trial balance. Please remember that. So there is a chance you will need to do a depreciation first. So make sure you get all the depreciation up to scratch and then trade it in. So just remember to do that as well. So on that note, thank you for watching along. This is a real tricky one, and I think for me personally, this is always the most challenging. So my advice, take it slow, read through the question, do it step by step. Don't try and do too many things at once. I wish you all the best. Thank you. Please remember, like, share, subscribe, all that jazz. And I will see you next time. See ya.